John Herrmann back with us from State Street. Of course, John Erlichman and Mike McKee with us as well from our markets team. And John, you know, John Herrmann, I'm just a little bit stunned by this time around because, you know, it's been the surprise on the actual number of jobs created, but this time the real surprise is this jobless rate.
Exactly. I mean, we did have a significant drop in the unemployment rate, but we want to also point out that 103,000 gain in the front month of December. You also have to look at the 70,000 upward revision to the back month of the back month. So that's all, it nets to about 173,000. Plus, the Labor Department has been consistently underestimating job growth now for the last, you know, several months, basically for almost every month of 2010. And every revision that comes in, just about every revision that comes in, has been to the upside. So this number of 103 with the back month revision to 70, that's about 173. That's more or less in line, first thing. Second thing is that we most likely expect to see an upward revision again, even in this number of this 103,000. So, you know, we may end up at something closer to 140,000 after the revision.
You mean that it could be a wash in the end? You mean, John, it could be
I think it could be a wash.
Okay.
Yeah, I definitely think it could be a wash in the end.
Hey, Betty, we should go back to something that Peter Cook just told us about, that the participation rate was a little bit lower during the month. Remember, anybody who thought maybe that the unemployment rate was going to tick higher was because more people were re-entering the workforce, that they felt more comfortable to go out there, and then there's a bigger pool of people that are looking for work, and that can hurt the unemployment rate. Here, where we're getting an unemployment rate that is better than expected, you actually have a little bit of a pullback in that number. So that's a little more context on what Peter Cook reported at right at 8:30.
Yeah, that's great.
And also, we also saw we saw some workers roll off of the unemployment lines because of the expiration of the emergency benefits. We did see some workers, so that could be part of this sharp drop. Maybe a tenth could be attributed to that. But overall,
you mean that's the reason why we've seen this drop in jobless rate, but that's not good news because they're rolling off and they're not finding any jobs long term.
Well, yeah, but I mean that could explain maybe a tenth of the decline. So I think overall, what it suggests is that basically the report that we saw for the month of November was really an outlier report of that jump up in the unemployment rate, that only 30,000 gain in 39,000 gain in jobs. It just suggests that November report really was an outlier and misrepresented the conditions in the labor market, and that labor market conditions are actually more favorable.
An outlier report, but it suggests that at this point we're still not seeing huge gains in confidence among employers to hire people. Right. When you see the number of people who were unemployed drop so much in the household survey, yes, that squares with what we're seeing in jobless claims, but we're not seeing the big rise in employment yet. They're getting productivity. When you look at the retail numbers, that's a real surprise. Yes. Given the holiday sales numbers, they're getting a lot of productivity out of the workers they have, and it raised the question of, do they feel like they really need to add a lot of people going forward, or will this be a really slow recovery?
Yes, to that point, the number that we got on retail jobs created during the month, 12,000, did not make up for the initial November number of losses that we saw, 28,000. So back to what John Herrmann was saying, even though perhaps there are more encouraging signs there, it looks like companies are able to do more with less in retail, which was expected to be one of the big reasons why that private number was going to be stronger this month.
Let me bring this also into the context of Bernanke, who's speaking in about an hour, because there were all these questions raised after this ADP report whether or not he's going to have to take his foot off the pedal a little bit more with stimulus. But this would suggest not, right?
Absolutely. This would suggest that Ben Bernanke sees the QE2 program through its entirety, all $600 billion purchases. And, you know, with Chairman Bernanke, he intends to be fairly aggressive in promoting jobs, promoting the recovery, and trying to push up the inflation rate. So, you know, by mid-year, he'll have a better sequence of unfolding of the economy to assess whether you actually may need to do a little bit more. But I think at this point, you know, we have to say we are basically at a spot where we are growing jobs. It's still at this, on average, around this 100 to 115,000 mark. That's really not enough. Significant enough to bring down the unemployment rate, to really sustain strong growth in the economy. And what it also suggests is that big retail sales gain that we saw in November and December probably pulled forward spending from the first quarter as consumers caught up, and without a real step up with jobs, we're not going to really grow retail sales that fast in the first quarter.
And what I read into that, John, is the message is watch out for January, February, March. And I want to get to that bond market with John because as Sara was pointing out, those yields were backing up to 3.5%. We kept trying to get to that a couple of times last year and we couldn't. And what do you make of this big move in the Treasuries?
I think, what we've seen is the Treasury market's basically looking at this report in a very measured way. I just ran through some of the numbers. We created, on average, 124,000 jobs in the third quarter. That improved to 128,000 jobs average in the fourth quarter. That's a very modest improvement. Maybe there'll be an upward revision to the December report. That I would expect that. But okay, so maybe we end at 134, 133,000 average in the fourth quarter. That's not a real material acceleration from the standpoint of third quarter to fourth quarter and to what you should expect in the first quarter. So we will have to ratchet down our views on growth a little bit going forward for the coming 6 months. And that's basically fitting with the idea that 10-year yields, which backed up after QE2, backed up to a 3.53% yield high on December 15th. That yield high is probably going to hold for a while because the retail sales that we generated in the fourth quarter looks like they probably pulled forward some of the spending from the first quarter and probably were also partially fueled by that big 21% rally in the stock market since the end of the summer.
So if that can be clear then, John, it sounds like all those trends we've seen in place over the last 12 months likely will stay in place among the asset prices, right? Or the
Correct.
assets.
And I think that's the right way to look at it. I think it's the similar way to look at the growth profile, the jobs profile, the spending profiles. This report is definitely disappointing from the standpoint of, do we get that sharp acceleration? Because it's not there in this report, even with the revisions. It's just suggesting the economy continues to make steady progress. But from the bigger perspective of all the stimulus that we've spent and the amount of QE that we've done and so on, it's a little bit of a disappointing report.
And Betty and John, just from a global perspective, put the U.S. recovery in perspective, still outshining some of the others. Deutsche Bank this morning writing in a note about the changing fortunes of the U.S. economy relative to what's happening in Europe, where the debt crisis is still spreading contagion, very much gripping that market. So that's a relative play, both in the bond market and in the currency market, and it's probably what's keeping pressure on the euro versus the dollar. And looking at even the yields play, you can see relative yields rising in the U.S. as the U.S. economy outperforms some of the other places in the world.
Okay, John, you have the last word. What does this set us up for then as we go into the January report? I mean, is this the bottom for the jobless rate for now?
I think most likely the unemployment rate will probably uptick 1/10 to about 9.5% in the next month's report. And then at that point, the economy is just going to have to just continue to gain traction. Business risk appetites are just going to have to make steady progress. The economy is going to have to leverage the tax relief that President Obama just passed. And we're just going to have to make progress. But the yields, for the 10-year, we've had a big sell-off in the 10-year and also in the belly since over the last couple of months. And those yields are probably going to drift a little bit lower.
John, thank you for staying with us. John Herrmann of State Street.